back, trend following, trading ideologues, where we discuss trend following, how many systems are enough, how many markets are enough. That's where we are. But we had some good tweets this week, and we can get into those. Richard's back, and that's good. And so that's always helpful to have the smartest guy on the planet about trend following with us. I've been on a few podcasts recently. Oh, yeah, I did the Covell thing, and that's going to come out after this ETF comes out. So I was able to talk about the ETF knowing that I wasn't talking about it before it came out. However, I got really messed up on that podcast because, believe it or not, I did not realize for 15 minutes that he was already recording. So I was like not on my best behavior, you know. And at the end, I said, I think I have some problems with what I was saying when I started because I was not making fun of people, but, I wasn't being careful. And he said, well, I can cut that out. Like, good. So hopefully I get a hold of him to do that so that it won't make me look bad. And yeah, so without further ado, Oleg, you can now speak. How's the technology today?
Hi to everyone. I'm very happy, very glad to be here. Hi, Jerry, Maritz, Richard, Andrew, Michael, Absolute, Alp, all the guys I see here, Josh, of course, and all the other guys. And I'm very glad to see you all the people who are here now. I'm glad to see you. So, I would say I was thinking about diversification a lot. And I'm thinking about diversification maybe for near 10 years or what. And I think that I agree with Jerry, I agree with Richard, I agree with maybe Maritz and Niels that there is, especially with Jerry and Richard, that there is not such thing like over diversification. So I think it's the more diversified we are, the better it is, and it cannot be something bad. Even we have 10,000 markets or something like this. I did not make such a research, of course, but I'm sure that diversification cannot do your system worse, and of course, it can. It's a very, very powerful tool, and the most powerful tools I know in Trendfall and space. I think it's necessary power tools. I think it's diversification and risk management. We can't be a 100% systematic classical trend following without a good diversification and a good risk management. So let's get started our interesting discussion, our trend following trading conversation, and so I'm very happy to be here.
Yes, sorry, Richard, I didn't invite you to speak, and I was asking you to speak, so sorry about that. Hopefully you're ready now to lead the discussion on 600 markets.
Okay, ready to rumble, Jerry. Hi, everyone. Good to be here. So, yes, look, that comment about 600 markets, when you said, well, that's the first question I'm going to ask on Spaces, I automatically started backtracking and thinking, God, did I overstate 600 markets? But if we have 57 of these trend-following programs, or these CTAs in this TTU index, we've already got Jerry Parker. How many do you have, Jerry, distinct markets? You got 300?
Yeah, I have 300, but I also have a list of short-only mega stocks, and I don't count those, as part of the 300. So 400.
Okay, so let's say 400. That's Jerry. He's one of the 57. We've got trans trend, and we know that they trade a lot of synthetics. So I don't know how many, but I know when Harold was talking with Niels on that mini series, I think they said they traded 300 markets in total. So I don't know how many synthetics there are in there, but I'm assuming there's a few. Got any ideas on that, Jerry?
No, but I think you have to weight it per trader. So you can't really, the clients who would invest in that are not getting 600 or 300. They're getting one out of 157th, weight the 300 that I trade, one divided by 57. So, they're not really getting that kind of weighting. If everybody traded 300 different markets, that would be pretty
Yeah.
cool.
Yeah. No, agreed. But if we're adding up, um, I'm assuming that the bulk of the 57 would probably be trading, let's say, 80 to 100 common instruments. Most of them would probably be trading the common futures instruments that are available. And then outside of that, we've got Jerry with your stocks. We've got Harold with his synthetics. We've got the guys dealing with the China. So Florin, Court, and Metori, and a few of the others. They're probably picking up a few in there. But I don't know. What do you think? Do you think 600 is overstated?
I don't really, yeah, maybe, but I do think it is a good idea. And but we're also getting into this discussion of this sort of hypothetical, which is not even a real world question, really, but it's just interesting to think about. Would you prefer more markets or more systems? And I thought that was headed in a really good direction. Uh, my well, Oleg is the head of my um, fan club, but it looks like Woody is in second place. So he was like trying to ask some nice questions, and I was like making fun of his questions. But it seems that people are a little bit confused. At least, for me, how my systems work is that they're all participating in these big trends because they all have pretty much loose pants. And they're pretty much all intolerable for most people to follow. My shortest term system would be somewhat difficult and would give back too much profit on a single trade, even though the back test says it's maybe a tad too short term. And if you want to maximize profit per risk, but but they basically all hang in there for the bulk of the trend, and then it's just a matter of which one gets out first and which one takes the most profit, or if the market turns back around after system one or two is exited and keeps going, then three and four are going to make more money. So it does over time. Not over time, they make about the same amount of money. So adding more systems or trading up to four, it really only gives me a little bit of diversification in the P&L of each trade sometimes, because I want them to be highly correlated when there's a big uptrend and a big outlier to be had, and they are. They're 100% correlated every day in orange juice and sugar and cocoa and cattle these days. But when those markets turn around, sometimes the short term is a better one because it crashes, or sometimes the short term is the worst one because when it gets out, the market keeps going. So there's a bit of benefit there. We're getting into a little bit, in y'all's opinion, there was a bit more advantage to trading multiple markets. Maybe you're thinking you do pick up trends or outliers. I didn't really see that. I see it the way I described it.
Yeah. So look, with the system diversification, I think you and I might slightly differ there. I think you're probably less inclined to diversify across the system path now, and maybe I'm a bit more prone to that. I think we both agree that market diversification is essential. But one of the things I've found with system diversification, I remember discussing it with you, Jerry, is that when I was trading my 5 trend following systems, this was 2022. My tests were using 5 trend following systems across, I don't know, maybe 60 markets. And I found that when I was looking at my distribution of outliers in my trade sample, I was getting around 7% of outliers, which sort of fits in with what you and I commonly talk about. 5 to 10% of our trades are outliers. And what I found in 2023, I was able to significantly enhance my diversification because of good year in 2022. When I started running my tests across 10 trend following systems, my percentage of outliers, my trade distribution, jumped from 7% using that backtest data that I was testing this across. Very similar data, same number of markets, about 60 markets, about 30 to 40 years history, maybe a tiny bit more this year because I had an extra year of data. But I was getting 13% of outliers in my trade distribution with 10 systems, which was almost a doubling from 7 the prior year with 5 systems. And I was sort of digging into the weeds of why that's the case. And so of those 10 systems, about 4 to 5 of them are actually breakout systems. So the reason I ensure that my core systems are what I call breakout systems, so Donchian breakout, classic breakout, is because those breakout systems, they never miss an outlier. However, what I do find is that they often don't get a very, as optimal a risk to reward as, you'd like, because you're always going for the breakout with the ATR, that tends to sort of spread it out. And the risk on those breakouts sort of means that, when you're catching an outlier, you get a really good run with those breakout systems. It always catches them, which is essential, which is a big tick, but it might not be getting the best risk to reward. So with those other 5 non-core systems, they're things like moving average crossovers, some different sorts of congestion breakout sort of techniques, that sort of stuff. But they're sort of supplementing those core strategies. And where I think this 13% of outliers is now coming from is that some of those systems, that your ability to get an outlier in your trade distribution is a consequence of 2 things. It's the market offering that outlier, and the second thing is your system able to capitalize on that outlier. And so some of those extra systems, those non-core systems, are getting these fantastic reward to risk ratios. Some of them are using a sort of a retracement entry into a trend technique, which is getting sometimes excellent reward to risk characteristics because it's got a very tight stop and you get this marvelous push and you get this magnificent outlier in your trade. And I think that's what's doing it. So, this diversification of trend following systems it's sort of, I think it's squeezing more juice out of the outliers. What do you think, Jerry?
Hey,
Okay, I think I was going to guess like something very similar, but I think I came to the opposite conclusion, which is I feel like that my breakout systems, which are long term in nature, it's almost an insult to them to say that they're hunting and catching outliers. I mean, they're not doing a damn thing except sitting there. And if it turns into an outlier, they catch every outlier. I mean, and so they're just like maximizing this open trade equity all the time, but they're not that good at keeping it, unless, like I said, the market has a sell off and the loose pants keeps the trade on, and then it has another leg up. And it just crushes it, right? So it is doing all it can do to maximize these outliers, at least in an open trade equity point of view. So if you say an outlier is 50 ATRs, they're getting 50 ATRs all the time. But booking 50 or even 30 in that situation would be maybe more difficult. They're not perfect at doing that. So what I thought maybe is that your initial systems before you went to 10 were more risk adjusted type systems where they're not hitting the outliers as much as, but they're really getting the risk adjusted piece correct. And so then if you add looser pants systems, the next 5 for a total of 10, you're opening, because they have these looser pants, you're coming up with way more outliers. Now, maybe you said it's the opposite. So, and then I think it does bring up another good point. Do we count outliers? How do we count them? Does it have to be a certain number of ATR? It should be a relatively straightforward forward formula. And do we count it as like the open trade equity? It was 50 or 100. Then that's an outlier. Then we evaluate how we did. How much of that do we keep? Or do we only look at it as how much we actually made on the particular trade?
Yeah, look, what I'm doing there is I'm saying let R be my risk per trade, the value R, or ATR for you, Jerry. And then I say, right, let's look at my trade distribution. I'll map it out in terms of R. And then what I do is I look at it and I see that the bulk of the distribution is sort of sitting between sort of minus 1R up to, say, 2R. And then I start seeing those tails to the right of that distribution. So it's about 2.5 to 3R. So what I'm saying to myself is, all right, let's classify in my terms an outlier being anything greater than 3R. On a per trade basis. So, a lot of them sort of a 17R, 20R, sort of up to 30R. Some of them are extreme, even higher than that. But that's sort of how I'm sort of classifying my outliers. But what I'm doing is I'm saying, all right, for my 2022 stats and for my 2023 stats, I use the same definition to be able to compare and contrast what I'm getting in terms of outliers in my trade distribution. And I'm still getting these. I am getting some magnificent outliers from these. They're just trades that, luckily, just snick the entry. They're in. They've got a very tight stop, so they've got maximum position size to risk the same amount of risk, and they just go like the clappers. And some of them you're just lucky, and they can be your biggest trades. Simply because the system was able to capitalise on that entry with a great position size and just nail it. So yeah, that's what I'm finding.
I'm sorry, but before I start, can you actually hear me? I'm spending a couple of hours on the beach. If it's too noisy, then I'll stop. So let me.
Gotcha, Moritz.
You got us? Okay, cool. I'd agree with. Well, it's my personal opinion is that I think that the diversification that is being offered to us by trading many different markets is greater and larger than what we can possibly achieve with diversifying across resilient and robustly well-built trend-following trading systems. Of course, if you're throwing together all sorts of systematic trading strategies, from mean reversion to trend following, all these sort of things, then you get a different picture. But if we're limiting ourselves, and if that's what we're doing here on this spaces, to trend following systems, then my observation is that the simplest ones, or the as Jerry would say, the ones with the loosest pants. That could be, by the way, a simple momentum system, right? So if the price today is higher than the price of X month ago, 3 months, 6 months, 12 months, whatever, then be long, otherwise be short. These type of systems, or a breakout system, they won't fail at getting you into the position. So that is the good thing. It's good. It's the yin and the yang, right? So they won't fail. They will get you into the position, and if there is an outlier trade to be had, you will have it. They also get us into a bunch of trades that, scratch, or they lose 1R, as you said, Richard, and it's kind of like the false breakout, and okay, we try again. Now, what I I trade these type of breakout systems, right? And I combine it with one that is a little bit pickier on the entry. I'm kind of like forcing the system to really buy the high. I'm forcing the system to really sell the low. So it gets me into the trade a little later, or maybe not at all, if in the meantime, there's a reversal in price. Now, when I look at the statistics of that system, they're very correlated, obviously, to a breakout system, and they actually come in a little bit better. But in terms of making the raw money, regardless of volatility and Sharpe ratio, the breakout system is the one that leads the pack. So if kind of like somebody put a knife to my back and said, Moritz, you have to choose between your two systems, you can only trade one, I would go for the breakout system, because it will get me these outlier trades, and And yes, it will get me a couple more of these, -1 R trades, or scratch trades, or -0.5 R trades, and but at least I think I have a greater confidence that I'll be getting all the trades, and that is first principles. That is important, right? It's getting all the trades, and therefore that's why I think that trading these different markets is. That is so important to me. I'm actually looking to get into some of the freight markets at the moment, doing some research on that. And we can create all sorts of. Jerry was just saying there's actually, let's define a couple of things. Like, let's define what an outlier trade is. Maybe we all define an outlier trade different. And let's define what a market is. Is a market a symbol that's being traded or listed on an exchange, or is it something that we can just create? Because if we call kind of like every expiration, when you think about the crude oil curve, right, it has monthly expirations. You can say, yeah, I'm trading 24 markets because I'm trading every single one of the first 24 crude oil markets. Okay, yeah, so those are 24 markets. Do the same in heating oil. I have no problem getting to 600 markets at all, but obviously they're from the same family tree, so maybe that's just one market. And the same is true for kind of like the synthetics. You create a crack spread, 3-2-1. WTI, heating oil, gasoline. It's still the same markets. Those three markets you probably already have in your portfolio. So you're creating a spread between them. There's a new market. Yeah, maybe. Maybe we'll get. Maybe it's easier for us if we said, how many individual symbols do you trade, and how many markets can you get to when you do this? And then Jerry trades the stocks. Okay, they're all different symbols. They're equities, but when you just look at the futures, it's kind of like very difficult to get to, more than 100, 120, something like that. I mean, I don't have a lot of money, and I can trade in these smaller markets, but I find it difficult to get to more than 100, to be quite honest. Like really different futures markets. I'll stop here.
Hi, Moritz. Can I ask you a question besides that? If you go beyond 50 or 60, you kind of get out of the CME credit risk, so to speak. You go to other futures exchanges, and then, well, if you go beyond futures exchanges, you go to trading against a counterparty. Is that something that you concerns you, going outside of the CME umbrella, or maybe CME and a couple more? Because that's something that always made me stop. Like, I don't want to get out of this huge behemoth of a futures exchange that I know it will not default, or I guess I think it will never default. Does that concern you?
So I'm not really concerned about trading on the Eurex, or on Euronext, or on the Liffey, or on the ASX. Like, all of these international exchanges, I must say, I don't, I didn't look into the details. It's like, how exactly does the clearinghouse of the CME work compared to how the clearinghouse of the Eurex exchange works. But they have their clearing firms. These firms are members of the exchange. In addition to the exchange with the clearinghouse's own proprietary capital, these firms need to backstop any shortfall. So I don't know. I didn't really look into the details, and I don't think I will. But trading on these large futures exchanges is absolutely fine with me, and I do it. And I'm not. I don't want to limit myself to just CME markets or the large American markets. That to me feels like I'm giving up too much diversification potential from accessing these other markets. And then OTC counterparties, I'm not taking any OTC counterparty risks. I'm not, like, unlike Florincord, or like any of these, or maybe even the very, very large CTAs, they would have ISDA agreements in place with all sorts of counterparties on the street to trade in more, like in swaps markets, or in more exotic currency markets, or to structure positions that have a specific payout profile, so it's no longer linear. And then, I'm not saying that is necessarily bad. It's a matter of, like, how do you manage your counterparty risk, and how frequently is collateral exchanged? Is it daily? What type of collateral is being posted? So this can actually be just as low risk as trading on the futures exchange, but it's obviously more involved because you need your own internal kind of like operations team and mid office and back office team looking after all these swaps and OTC trades that you're doing. So that, for me, I'm A, not large enough, and B, that's just too much of a burden on the operations of what I'm doing right now. So I can't do this. But if you're AHL, yeah, you have the engine room to make that happen, and they can probably control it nicely. So hopefully that answers your question.
So, Richard, I wanted you to comment on my assumption that the reason you started seeing basically more outliers when you started adding more systems was because the systems that you added were looser pants and picking up more outliers.
Well, what I've done is I have sort of drilled down into these particular trades and developed by these, what I'm calling these non-core systems. So totally agree with Moritz. Your core systems must be breakout models because that means you never miss the outlier. So totally in agreement there. But the supplementary systems I'm adding, when I'm looking at my orange juice trade or my London sugar trade and things like that, some of these trades that have been running for the past 3-4 years were actually trades that just by random chance have been able to sneak the entry at the optimal position, and they're still running today. So all of my models, the core and non-core, they all are loose pants. So what I do is I have 6 or 7 parameters only in any of my models. Whether I'm using a breakout model or whether I'm using a retracement entry into trend model or whether I'm using a Davis box congestion breakout or whether I'm using a regression line trader, all of these things, the only thing that's really varying is the entry. The loose pants is applied to all of them, and all of the models are applying an ATR-based stop and an ATR-based trailing stop, the chandelier mechanism that I deploy for all my models. So that's common throughout it. So it's the entry that differs. And when I look at so what I do is I say, well, why was it that some of these systems were able to capture these glorious return to risk profiles, level of dollar risk, but because of the particular entry technique, some of them have been able to come in at a high position size, even though they're risking the same amount of dollars. And some of them just happen to be in the right place. So what I'm doing is all of these models are using, medium to long-term look-backs. So they're not participating in the market at all times. They're very selective when they're participating. But when those material trends are happening, some of them might be waiting for a retracement entry into trend, and it just happens that they snick the entry at a perfect time. So, there are swings and roundabouts I'm getting in that, yes, the supplementary models they're not as efficient as the breakout models in catching every single outlier, but sometimes when they do catch that outlier, they're glorious trades, and they are, in many instances, exceeding the return profile of the breakout trades. So, when I start looking at a month, I look at I trade on the daily time frame, but when I look at the monthly charts and I look where did these particular entries occur on a monthly chart and I eyeball it, some of them are just optimally positioned at the time where, in hindsight, of course, that's where you want that trade to trigger, and these happen to snag it. Breakouts are really great models, but you're requiring a higher high or you're requiring a lower low. So they might not be getting the same reward to risk profile, but they are catching all the outliers. So it's not because I'm using risk-adjusted models or anything like that, Jerry. I'm definitely not doing that with my models, but what I am doing is I'm just diversifying my trend following models to get a diversified entry. And the reason I'm diversifying my entry is I'm trying to spread the impact of outliers across the distribution as opposed to being concentrated at particular locales. I'm trying to spread the benefit of outliers throughout the portfolio distribution of trade returns so it's not as lumpy. And this method I'm deploying seems to be working because 4 or 5 of the models are catching, the outlier using breakout techniques, which is catching every one of them. And some of them are getting fantastic returns just by being selective in their entry. And I think the swings and roundabouts means that sometimes these results pay for the fact that you don't necessarily catch all the outliers with the supplementary models, the moving average crossovers and these things. They sometimes miss the outlier, but when they do get the outlier, some of their profitability of these models are so extreme that it pays for the fact that it occasionally misses it. So that's sort of where I'm thinking at the moment.
Okay. All right. I think I understand now. Okay. So basically, yeah, I think that I don't. That was a big no-no back in the day. We used these breakouts, and we used to have a few filters, and I have a filter that sort of pays attention to the level of consolidation or false breakouts. So if it has been a really choppy market, it just gets in at the breakout. If it has not been a choppy market and the market has been sort of profitable recently from a trend following point of view, then I wait for the break. I don't take the breakout until this other filter is satisfied. Now, and that helps spread things out as well, having a filter. However, all good filters eventually they will never prevent you from taking a trade and missing an outlier. You'll always hit every outlier eventually. Eventually, I will get in, and it won't be much different, honestly, than just using breakouts alone. So that is something, and I can set the parameters on these filters to ensure that I don't miss a big trend. So that's probably where we're all coming from. So it's not even a question for me whether I'm going to maximize the outliers. It's just, and another thing too is I sort of gave up a long time ago. I had this in 2012. I had tremendous relative underperformance. So I looked at some of my trades and I was like saying, yeah, I'm getting in some of these trades when the consolidations are tight. All four systems are getting in on the same day at the same price. That's what breakouts will do. They have a tendency, regardless, unless you screw them up a bit into where you're reducing some of the robustness because you're hell bent on making sure you don't put the whole trade on at the same time, and you always get this benefit of multiple systems. But you don't get that with breakouts all the time. So I just gave up with that, and I realized that that really wasn't my problem. I thought it was, but it really ultimately wasn't. So um, that's kind of a bummer. People really hate. I'm trading 4, 5, or 10 systems, breakouts, and they all get in on the same day sometimes, and they all get out on the same day sometimes. Yeah, I think you just got to suck it up. And of course, that gets tremendously minimized, that anxiety, in my case, because I do trade 300 markets. And if all four systems take a loss with the stop loss, it's 15 basis points. It's less than that, but I'm embarrassed to say exactly what it is because 15 sounds low, and the real number is ridiculously low. So another thing, I posted this chart of NVIDIA, and I wanted to post that to show people that I'm not always correct, because I've sort of been down on these big companies, going long big companies, but sometimes I've seen in the data as well that it just doesn't. It does happen sometimes that these large companies they have some big trends, and so don't listen to me. I do it my way, and but there's always exceptions. Crappy ideas, bad ideas. They have their day in the sun, and they're not. Every trade is not bad or suboptimal. So Nvidia, yeah, it looks good. So I posted that chart, and it was like 100% win from the breakout, but only a 20 ATR profit, so not that much. And it just brought to my mind like how we size our trades and how the rest of the world looks at percentages all the time. And we're looking at things in terms of ATR, which is much better. And it has some limiting factors that you can't like load up on a certain trades when the ATR is really high. but like other people can, and especially short trades, really limits. I think it really limits the short trades. But yeah, so the point I wanted to make was so many of my big outliers have been sort of lucky in that the ATR was so small. Like I think that Tesla trade was 87 cents. I mean, that's ridiculous, right? And I had this monster position on, and that's kind of what drove that profit as much as the trend was sizing it like that and not getting out. It went 50 ATRs initially, and then it retraced 49 ATRs thereabouts, and I didn't get out. And so there you have it. When you get out with some of these take profits and you pay attention to something called risk adjusted, then you're susceptible to really screwing up the trade and you lose that initial ATR. Because if you get out, then you've got to get back in at the highs. Okay, that's bad enough. Now the ATR is God knows what. So you're going to have a much smaller position. So I don't even like to have tight stops. I have optimal stop losses, which I just optimized it on the back test. And it's not that close. It is a stop loss, but it's not as close as 2 ATR, which is like the old turtle. It's way bigger than that. So, and I think one of the things the computer says is, hey, you're taking an optimal loss. You don't want to get whipsawed. And also I'm putting into my calculation resizing the trade if you get out very quickly. And if you pay, you're going to get penalized in trend following if you pay attention to anything called risk adjusted. You're going to make less money. Well, then how are you? What is your risk management then? My risk management is risking 15 basis points per trade, trading lots of markets, long and short, with lots of diversification, and not using my current AUM as my trade level. It's allowing me to optimize what I do on the entries and exits, but I have this inherent built-in amazing risk of that helps me not lose too much of my capital, but is in no way does it speak this language of something like risk-adjusted returns. It's no, it I don't use when I measure risk. I dig deeper. It's nothing that you can find on a stupid performance table. It's something that bugs the hell out of me. All of the solutions on risk, return versus risk, must come from the published performance table. No, that's for y'all. It's not for me.
You can get outliers from two reasons. One is the nature of the market itself is offering an outlier in terms of the price move, but then sometimes your systems are configured where you get in, with very low volatility, small ATR, and bang, you get this massive outlier trade. And when you actually look at the market data that produced that outlier trade, you think, hey, that wasn't that big a trend, but your system was just optimally configured to catch that move, which is what you're finding. I'm finding that the same with my model. So, an outlier trade can be from two sources, your system, or it can be from the market data, or it could be a combination of both. That's the way I'm seeing it.
And I want to say that it's a real beauty of trend following when we see this low ATR in the beginning of the trades, and I have mentioned it maybe 7 or 8 years ago when I did a lot of backtest, a lot of research on this topic, and it's really beautiful how we have a low ATR in the beginning of the trend because of consolidation. Before big trends, we often see big consolidations. And it's so beautiful how it works. And we catch these outliers with low ATR. It's really wonderful.
Great point, Oleg.
Cherry, there was a time when, I understood trend following as being long volatility, so to speak, in a simplified way. And I always thought that using too tight stops was like being short volatility in the short term and long volatility in the long term, right? Like if you put it too tight, it's like every time volatility rises in a natural way, you will be losing money. So that was one way of viewing it for me. Being short, if you are too tight, you're short volatility in the long term, in the short term. Sorry.
Yeah, I remember when I first got into managing money at Chesapeake, and people would tell me and write things about how volatility, and some of the things they would say would be the opposite of me. I kind of knew, that initially it's more complicated. Initially, we want low vol so we can throw on a huge position. Now, I've been kind of burned by throwing on these huge positions, but most of the time, knock on wood, you're what's going to happen when you get burned is that you had a big huge profit and then it crashes, and now your profit is not as big as it was. It's much harder for the market to f you up uh, on a losing trade because you put the trade on, it fails to break out, you take your small loss. Nothing is happening. If the breakout starts going, then things are happening, right? And people are paying attention. But if it's just breaking out of consolidation and then it goes right back into consolidation and you take your stop loss, probably nothing there that's going to cause you to wake up one morning and see a massive. So you wanted to lose 5 ATRs and you end up losing 15. I mean, it can happen, of course, but you've made 50 ATRs, original ATR. It's the original of your entry since we're not going to vol manage, and then the ATR has doubled or tripled since original, and so then you wake up one day and your 50 ATR profit is now 30 because it's gone down a bit, and then you multiply that times the increase in ATR since you bought it, so it's really giving back quite a bit of profit. And so you're usually going to be faced with these very uncomfortable situations during periods and on trades where you've made a ton of money. I was trying to think another way too to compliment us, improve how right we are in the sense that and I don't know how to formulate this, but I remember, leaving the Turtle program and hearing people talk not so much about the trades any longer. The non-normality was not each individual trade sized by ATR at entry. It was some sort of performance table thing, like the monthly outliers or it was not using ATR but using percentage. And I thought this is just way off. They should not do that. You're mixing in some frivolous ideas and it's polluting your information that you're getting from your research and from your actual trading. And I was just thinking recently, that the great thing about an inch, a foot, a yard, and a mile, which I know you Europeans don't use that stuff, is that it never changes. It's always consistent and constant. It's not based on anything else. A foot is a foot. It's 12 inches. And I think that's the way with using ATR. If you use the ATR at your entry point, it just normalizes everything, and it's just this perfect measurement forever for the life of that trade. That's what you need to measure, and I think corrupting that measurement by putting in this percentage, it leads to this silly thing, which is just ridiculous. Which is if you're down 50%, you have to make 100% to get back to break even. Yeah, that's because you're using percentages, dumbass. Don't do that. If you lose 10 ATR, you have to make 10 ATR to get back to break even. That's much better, much cleaner, much more honest.
Jerry, can I drill down on the ATR aspect to cause some definitionals this morning?
Please.
I was okay. Caveat: I have to always say this. Jerry's mutual fund EQCHX is my largest retirement holding, and I cannot wait for the can't name it till July, perhaps TFPN ETF. So there's that. So I had to get my arms around this ATR because I kept getting stopped out of my long only, stocks only, trend following small scale experiment at Robinhood with single dollar entries, fractional per market. I have currently about 360 single stocks in buck each. So I'm a small trader, retail trader. I give my money over to the big boys for the the currencies and the commodities and the credit markets. I'm just playing here in the small end, but no less enthusiastic, and that's why I hang out with you guys on Spaces. So ATR. Well, ATR, as I discovered when talking with ChatGPT, where I have to kind of really develop my own thinking to ask good questions. ATR has three aspects to it that I have been investigating. One is what's its nature, its calculus. There's a kind of if you had a 14-day ATR, you do a simple average, maybe a 14-day, divided by 14. But there's also those weighted ATRs. So what's the nature, the calculus? Some people overweight more recent figures. I don't. I go simple. How far is the look back in number of days? I've been doing 14. I don't know. I studied with Cavell, and that's kind of how I got into all this. And I'm just going simple. Sorry to Richard's 10 systems and Jerry's 4. I'm just a simple man with one system. I'm just starting out. Sometimes stuff's too complex for me. So I have a 14-day look back, but I don't like it because it keeps stopping me out of things that I should be holding on to longer. And Jerry was nice enough to tweet with me saying, "Looser pants, son. You can never be too loose." And so I had been investigating 15 to 25 ATR. So what's the look back number of days for ATR? So that's the second aspect of ATR. What's its calculus? What's its look back? And then what's the X factor for a stop loss exit? I've been using three of those, but maybe it should be 4 or 5. And I'm just looking to not be so disappointed in getting stopped out so often. Thanks. Comments welcomed on nature, calculus, look back number of days, and the X factor.
I don't know what the X factor is. I think,
Three, for example, you say 3 ATR. When you say 3 ATR, it's kind of 3 of those ATRs. Well, what do you mean by ATR? Is it a simple calculus? Is it weighted? Is it how many number of days is that ATR? So that's what I'm saying.
Yeah, I mean, I like simple average, and then I would say 3 or 4 weeks is probably going to give you about the same performance. I think most important thing is to be consistent and just decide how you want to do it, and just follow that rule. And I think that 3 is too tight for me, but you really just have to do some back test and to see what happens when you make it larger, and if that's something that you can tolerate. I wanted to also mention that
Thanks.
I think that ATR is not very good for too many things other than sizing the positions. I think after that, you just kind of throw it away. And then, of course, it helps you calculate your exit. But I tried to use it, and I know that it was never meant in my world to be anything other than normalizing giving each trade the same dollar loss and the same room, the same number of ATRs before you got out, and then normalizing your losses to a certain dollar amount that's a percentage of your capital. So I think people try to use it as some sort of technical indicator, or 15 ATR trailing stop in some way. And I think it's just disappointed me in the way that I've tried to expand ATR. And there's been some recent podcasts that where people talk about, we're going to make it really short-term look back. We're going to get some knowledge from this. We're going to pick up on volatility changes, and we're going to act on them. And of course, I would never go for that. But yeah, I don't think ATR has much going for it. It's better to use these breakouts or moving average crossovers or some sort of way to signal entries and exits, and then I'm done with ATR pretty much after that.
Yeah, I agree with that. I think use the ATR to size the position to evaluate the trade outcome. So how many ATRs did you make? and maybe if you run a chandelier type of exit, then it plays a role there. But for everything else, you don't really need it. By the way, I must say I love what Jerry just said about the recovering from a drawdown. Like, if you're down 50%, you need to make 100. And when you said, yeah, you dumbass, that only works. That's only true in percentage land. That's no longer true in ATR land. That is true. Like once you put it's a frame of mind. Once you put your thinking into an ATR world, I think it just makes my life easier. Yeah, it is the easier calculus for me, dumbass. I don't have to do all the other complex stuff. It normalizes everything. It's just a more consistent quantitative world, I think, that we can operate in. But I wanted to comment on your question on the ATR, like the look back window, or whether you do like a weighted ATR or a simple ATR. And on my system, I've played around with these things. But honestly, you don't want your system to be sensitive, in my opinion, to be to any of these things. Like whether you're using an exponentially weighted ATR or a simple ATR, if that makes a meaningful difference, that is no longer a resilient breakout trading system, trend following trading system. I think it shouldn't make a hell of a difference. The same is true for the look back window. Like if you go from 14 to 21, or even like 60-day look back on an ATR, sure, I mean the individual trade may have a slightly different position size, but sometimes it's going to be the exact same position size, because the difference between a 14-day ATR and a 20-day RTR isn't normally that large. So your system should not be sensitive to that. And then I think what you're working or trying to figure out is what's your initial stop. I think that's what you mean by the X factor, or how many ATRs do you want to risk, and there is no one answer to this. If there were, then hopefully one of us will find it. But this is just you and your system. How do you want it to run? What can you cope with? How much heat can you take? How frequently do you accept being kicked out of these positions? That is really just something that you and yourself only, you and you only, you need to find that value that works for you, and that's it.
And I like the idea that when our position size and our initial stop is based on the volatility, so on the ATR, it's really great. It gives adaptability to our system. It's very important. And of course, the only way I like to use ATR is for initial stop, but it's a great way. So I like it really very much, like you do.
Yeah, so a long time ago, I was really fixated on ATR and just trying to put it to bed and be happy with and understand how it kind of works. I think there's some other things going on with it. You can kind of tell if your ATR calculation is perfect, or more perfect. And I noticed that I had some issues in some markets that it was understating the ATR, and I looked into this, and I remember, and even today, you can kind of see that ATR has an issue. Well, you probably don't think it's an issue, but I do, and it is that if you look at like let's say something like the Mexican peso or Euro Czech, and you look at that in the futures market and you compare the ATR of those somewhat illiquid futures to really very, very liquid cash market, and the ATR will be way off. It's very different. So I like to look at, and it's because that some of these currency and cross currency futures are very illiquid. They don't really trade, and they just post the price at the end of the day, and it's a good price. it's worthwhile looking at some of these futures because it's an indication, like especially in something like Russian ruble or Thai, Turkish lira, where you can see that the futures is way different than the cash FX, and you're going to be trading in the futures, or you're going to be trading the FX rolled out to, let's say, the futures prompt date, and so you're going to get the movement of the future. And so you really kind of do want to follow that futures chart a bit, and you want that ATR to be correct. And so I came up with a way uh, to handle that, to where in any markets that if it's not very liquid, not just a currency, but other markets that are not liquid, my adjusted ATR, which is on bar chart, uh, it it handles that perfectly. So, but initially what I did was I had a bad idea, which is we would tell the computer, take the highest of the two, the normal ATR calculation or this other ATR calculation that we came up with. And we would just say, hey, to be maximally conservative, take the highest number. And performance was worse on the back test. And it bothered a lot of people. And they were like, this is worse. And I was like, oh, just forget it. It's fine. But then I realized why it was worse. It's worse because not because one is better than the other. It's that I wasn't being consistent. I wasn't deciding how to handle this, deciding which calculation I wanted, and just going with it. And sometimes it's going to be the lower number, or sometimes it's going to be the higher number, but you've got to make your mind up. And the computer was just saying, to us, you're being inconsistent. Sometimes you choose this rule, sometimes you choose that rule. And it's no different that sometimes I buy the 100-day high and sometimes I don't. I buy another day high because of whatever, because of the way I'm feeling or the market needs to show me more strength or something. This is technical analysis, which is not that good. It's not trend following, which demands 100% objective, systematic rules that you follow all the time. You can't switch back and forth. And so that was the lesson. Obviously I knew that lesson, but it was interesting that these ideas creep into your models, into your systems, where you're essentially following rules, but the way you have them set up, you're not consistently following the same rule. This is why I'm so against the second type of exit. Exit at the breakout or exit if volatility is high. This or thing is a major problem. Exit at the breakout and exit if vol is at a certain level. That's much better. You know exactly what your sample size is. You've reduced it quite a bit, but at least you know. And that's going to work out much better than having these or exits. Do it this way or that way. And you can see where it's just headed nowhere.
And Jerry, can I ask you something? Do you have the idea that those trades that start with a compressed ATR are better in general, or that's something that you have in mind but doesn't show in reality? I mean, at the end, they tend to be more outliers using whatever historically data you have at the moment.
Well, I definitely looked into that. I remember my first idea was, it was let's test. I mean, this was like the 90s. Let's test if we only buy the bonds. And back then, there was like maybe the 10 years, but I think it was pretty much the 30 years when I first started trading. So it was 30 years in euro dollars. That was pretty much mostly it in my world. So I remember saying, let's test to see what happens if we only buy the bonds if the ATR is less than 1 point, so 32 ticks. And this is the type of ridiculously stupid research that everyone has to do. You don't have to follow it. I did it.
Yeah, I know that.
It's okay to do it. And then maybe, I'm not saying, maybe I've implemented some bad ideas, but I was always very quick to get really angry at not making as much money as I should, missing a big trend, and then getting my religion back, saying, what the hell are you doing? Don't do that. You know better. And so, of course, the computer will fine-tune that rule based upon the history. And then next trade or two will be a big outlier, and the ATR in the bonds was more than a point. Oh, so it's all screwed up now. So you're limiting your sample size. You're wedding yourself to what's happened in the past. And so I think you got to be very careful on these type of filters. Now, a good filter is maybe something like, I will buy the 100-day high if the ATR is less than a point, but when it gets to the 125-day high, I'm in, regardless. I mean, I think that's not as bad because you're eventually going to get in. It's probably just doesn't it's probably not worth very much. It probably doesn't help performance a great deal because you're not giving it much chance to really operate. It's going to pick up a lot of quote unquote bad trades, and so it's not going to do what you want it to. But you cannot have filters or things that delay you buying and entering these markets that keep you out permanently. And then, oh yeah, I would never, just on principle. I mean, I love, Moritz said something that really hits home with me. Rather than buying retracements, we actually, I've said this. We tried to figure out ways to buy the high of the day. Everyone hates buying the high of the day. The people that taught me how to trade were from the floor, and so buying the high of the day on the floor is like the worst thing possible. And so we actually thought, well, let's just try to buy the high of the day because that's probably going to be better than anything else. And it made the average trade 10% better if you just try to be so perverse and you're going to be this amazing trend follower every second, minute, hour of the day. You're just trying to always buy higher prices. Like if we had a gap up, like we wanted to buy at 50, but before we could, it gapped up to 100. And then let's say it sold off to 75. So we're 25 above the entry, but we've got a 25 sell off from the high, this gap open. We would wait until 101. See how bad that is? You're just seeking pain and suffering. And then as soon as you get filled at 101, you take a small loss. It goes straight down.
Nuts.
Yeah, I guess if you could always remember the rule about sample size every time you get an idea, it will straighten up many of your one's research efforts, right? That's something that I tend to forget, but it's a great starting question. If I do this, what happens to my sample size? I remember thinking about that the other day when I thought about MACD filters. They look great because if you have a shorter system than a MACD with a longer period, it will help you confirm the overall direction in multiple time frames. That's right, but at the same time, it reduces a lot your sample size.
Oh, I mean, of course, I harp on this all the time. This is what I've said is whenever someone asks you a question about trading, regardless of what the question is, the answer is always sample size. You start there, and that's the way that I was taught. I know Richard doesn't do that, but I think that that's the way that I was taught to do it. And so we would come up with a list like things that we are not allowed to research. We believe in these particular things, and we're not going to even research these things because they're anti what we believe in. And so we had a very short list that we could even allow ourselves to do research on because we were very proud of this list of, of no-nos. We don't believe in certain things, and here's what we do believe in. So it really limited our mischievousness of optimization, even though we did it and we repented. I mean, we made mistakes and we shouldn't have done it. So, and I'm famous also for, and I remember getting, I don't know if I've told you this story, but I remember working with Salem. Salem and I worked on research projects together because we had one of the first copies of it was called System Writer, back then, and I forgot what it's called now, but it's the first package where you could do research. And it didn't come with the ability to add the equity curves together. So you would just do each market one at a time with your system, and it would just output the trade stats. But you really had to hook up Excel and export the files and export the trades and the daily equity for each market and do that sort of combination of all your markets into an Excel spreadsheet. And I remember saying, "Oh yeah, well I don't even believe in that. So I'm all about the trade stats and trade stats only. Not that I'm not curious as to what the the equity curve on the back test looks like. I'm just not going to pay attention to it too much."
Yeah, I guess when you the issue with that stance, I mean, if that's an issue, is that when you're managing other people's money, putting rules to refuse to do some research, maybe it sometimes will be seen as not wanting to innovate. You know what I mean? If you, for example, see the literature of many of the big funds, even trend followers, the continuous research is something as a sold value, something that's good. And I think it's good if it doesn't go into, a dangerous place. But that's some issue that you have when you're managing OPM.
Oh, 100%. That's a very good point. Um, yeah, and I think recently on this in this spaces, I've talked about just reading articles or listening to podcasts. Especially, I thoroughly enjoyed that wonderful series that Niels did with Alan, interviewing all the CTAs. I just thought it was fascinating, and I just loved it. Um, and I got a lot of good insights. And
You're coming up, Jerry, by the way, I believe.
yeah, I'll be coming up in July. Yeah, so that was fun. And so I got into this idea. I know we were talking on the spaces where there's so much evolving and research going on with these really fast computers. I have a little MacBook, but I do have research people on my staff, and they're always researching stuff. And I was just on this spaces I just mentioned, like I don't think I have evolved very much. I kept everything intact. I lengthened my look back. I lengthened my stop loss, and then I just started adding a ton of markets. Every futures market possible, every currency market possible, every commodity.
Isn't that a big evolution, Jerry, in
Yeah, then
itself?
Richard. Yeah, that's what I was going to say. You corrected me and say, no, you're doing fine. You're evolving in this particular way, and I'm like, yeah, I think okay, I'll take that. Thank you very much. And but yeah, it's so. What am I going to do next? I'm going to maybe have to move my shortest term system out a bit with a bigger look back. Then I'll be set for another 20 years. So it is kind of interesting. I hopefully I have all these talking points that when I go on my tour, my ETF tour, with on the podcast and whatever whoever lets me on to talk about the ETF. I one of them I forgot on the last one with Covell, but I kind of wanted to say and this is really not probably very helpful, but we're only charging 100 basis points, so come on. But and we're doing a lot of work with these 300 markets, and but I think to some degree, and this is just between us, so I don't want to repeat this. I probably shouldn't repeat this with Niels, but it's kind of like it reminds me of what we're trying to do. It's like the S&P. It's like we've come up with this strategy. It's going to be cap weighted. It's going to be something anybody can buy. I don't think I could calculate it. It's probably a pretty tough calculation with a spreadsheet. I'm glad S&P is in charge, and I could just buy the index if I wanted to at almost 0 bips. But I think to some degree, we've come up with this strategy. It's one entry, one exit, and a stop loss. Add all these markets. There's a lot going on. It's a little complex. Um, I talk about philosophy, how we do things, and then very next time I get a question that I've already answered. That happens all the time. So I don't know if people are listening or cannot really figure it out. Why should they? They don't really have to. All this trade level stuff and ATR stuff and all the stuff that for all of us who've been doing it for many years, kind of take for granted. It's a little difficult to understand it and put it all together. Then you got to do it. Then you got to find the equities. So it's what we do for a living. And we're only charged 100 basis points, but to some degree, it's a little bit like the S&P, where it's there's no reason to change it. Is the S&P going to change? Is it going to figure out a different way of calculating market cap, or market cap doesn't work, so let's try something new? No, it's probably not going to do that. So these breakouts are great. They keep you in the trends. They're loose pants. They're very hard to do. They're so counterintuitive. They're not nearly as fun as a moving average. They're a little bit perverse. So that's what we're offering. Eat your broccoli. This is hard to do. You can't do it. You're weak. We can do it. And we're only going to charge you a little bit. So I think in the same way, I don't expect to see these massive changes. I have no interest whatsoever, just like the S&P. I have no interest in smoothing it out for you. Man up and buy the right stuff and do the hard thing.
And Jerry, there's another thing with, I mean, as you said, now that I realize, index funds are even more stubborn, so to speak, than us trend followers, because they don't change anything. They never do. I mean, there are very small things that they change, but they keep doing the same and the same. But there is another issue with because trend following kind of accepts its place in a portfolio, right? I mean, there are some people that do 100% trend following, but most of the time it's a component of a portfolio. But the issue with the index fund is that people sell the idea that that's what the market is. And you can say that the market cap of all the companies in the world is an index fund, like the ACWI. But if you see investors, there's no one investor in the world that has that asset allocation. So it's kind of a confusing idea. I mean, you can say that an ATR is a confusing idea for somebody who never used it, but the fact that the market exists as a beta or as something that somebody has, if you see all institutional investors in the world, you will see that they all have home bias, and none of them has that full market that the index is selling by itself. So, I mean, it's a great idea on the marketing side, and it's backed up with academia and stuff. But it's also a confusing idea, in my opinion.
Well, I think they can get away with over time. They figured out a way that this is the market, and it's the market, and everybody quotes it. You don't even have to say S&P. You just say the market, and that's a pretty darn good marketing accomplishment. And it is primarily because it's made money, and it's hard to beat. And I think in the same way, I left that part out. I think that what this classic trend following with lots of markets and a handful of different systems with a proper look back period and not vol management and correlation management, it's going to be hard to beat. And so just like the S&P is very difficult for people to beat. However, I do think that my whole reason for existing these days is to not agree with what you said, in that people know where trend following fits in. So for me, I'm going to try to make the argument that it fits in as 80 to 90% of your entire portfolio. It's an index like the S&P with 300 markets or whatever, not 500, but our algorithm is much better. It makes money more consistently. It doesn't have the drawdowns relative to the return that the S&P has. It has a lot of stocks in it. It's not going to miss a big bull market, but it's not safe, and it's not. You're not going to make as much money if you don't include the other sectors, currencies, commodities, and interest rates, and the shorts. So it is not a perfect hedge. It's the perfect portfolio. And, I'm in perfect place to sort of be Don Quixote in this. Okay, so that's probably what I'm going to end up doing for the rest of my life, is not accepting that this particular strategy, which is available to anyone. Anybody can copy me. Maybe you can't replicate it, but you can certainly copy it. And do your own version of the stocks in the mix. But you've got to get in the game and trade the stocks with the trend following, and really give people and make it highly likely that you're going to have the opportunity to outperform and do better because you're adding all these other markets.
What I like about this approach, and as I said, I can't wait for the ETF, Jerry. I love the comprehensivity of it because it's all tradable, liquid markets. It's what's happening. Yeah, you're not going to have artwork or collectible cars or, the more less liquid and more esoteric, but you can have the kind of most common assets with a trend following support and approach. And I think that can't be beat. Thanks.
About index funds, there's also some coincidence that's happening. The world is it's very US centric, and today the US weight of the total equity market cap is like 70%, which makes it just by luck it's the same as what some a US investor with a home bias will invest, or maybe even more. But that's just a coincidence. I mean, if you see what a US investor has in equities today in the US, it's the same as the overall market. But if you go to the second one, the Japanese investor, which theoretically weights 7% of the total market cap of the world, they will have much, much more in their own equities. So, by coincidence, the first one looks exactly like the theoretical calculation, and that's just luck. In the 90s, you have like 40% in the US and 30% in Japan, and that made much more sense. So that I think that distorts also the picture, meaning that it looks like it makes sense to be totally systematic in index funds.
Well, this week I've been reading a bit. I think Cliff and Meb, I don't know if it was this week, but they have a tendency. Somebody was bringing up this whole idea of should Americans, I don't know if it's just Americans, but people who prefer the U.S. stock market or invest in the S&P, should they also include international other non-U.S. markets? And I think if you look at that performance historically, the S&P is outperformed. And if you had diversified, and you're not getting a great deal of diversification anyways, but if you had diversified, you would have made a lot less money by adding these non-U.S. indices to your portfolio. And I live in a different world. It's just like, well, I would add those stocks possibly, or any market to my portfolio strictly based on and only based on, is it adding diversification to my portfolio? Is there any indication that that it won't go in lockstep with U.S. stocks or the S&P? And then, okay, it's in, because the trend following rehabilitates the buy and hold performance and makes it into great performance because it uses breakouts and stop losses and goes with the trend and takes small losses. So markets that have not made money historically, or indices that have, if you added them to your portfolio historically, have caused you to make less money, this is not even relevant to us. We're all of our markets have the same expectation of the same profit potential. Maybe not historically, but I think philosophically, mathematically, in the future, they will. It's totally irrelevant how they've performed in the past, not irrelevant how they benefit the diversified portfolio. Even though that might change. And all we're doing really, too, is trying to just overwhelm the performance with so many markets that it's difficult to get the correlations incorrect. And we're not really focusing on that as much as hunting the outliers anyways. So, I think that when you hear these things and you see the box that they put themselves in because they won't embrace trend and, and like I said before, I think that obviously the biggest people who would disagree with this whole strategy of adding, hundreds of stocks to a trend following portfolio to make sure that we get that performance when the stocks are the only sector really having big trends. The biggest people who would disagree with that are the managed future CTAs themselves, because they're have within their power to do exactly what I did. Um, too busy evolving and doing research on better systems and over optimizing, overfitting, but don't have time to add these incredibly wonderful markets.
And I like the idea that trend following system idea of Jerry, that a trend following system will improve all the markets, even markets that are non-profitable historically in buy and hold, that they can be profitable in a trend following style, and trend following strategy will make them profitable. We will make money from these markets, and all the markets have the same expectation. It's a wonderful philosophy. So I fully agree with this.
Yeah, I read some of those AQR papers, and what I think they also say is that because most people say, well, why will I diversify if when the drawdown comes, every market moves the same on the same lockstep, and they say, well, that's right, but you have to also think about long term. In the long term, different international markets bring you diversification the same way as trend followers will say, okay, trade cotton in different exchanges because that will add diversification. So what they're saying, I think it's the same. They will add this diversification, but of course they will not be of much help when the drawdown comes, and that's something that they realize. Instead, if you are doing, cutting your losses short, that will help you a lot. And I think that, I mean, I will not do index funds in any case, because that means that you have to stomach a 70% drawdown on your equity, because that's something that can happen without a doubt on that one. And I think some people will be able to stomach that. I won't. So that's one of the reasons why I prefer these kind of systems.
Hi guys, can you hear me?
Yes.
Yes.
Hey Jerry, hey everyone. I mean, it's just amazing conversation today. It's really, really good. It's just that sort of the conversation that you cannot hear easily or any other platform. So it's very, very enlightening. And I was fascinated since the start of this conversation, and I'm just listening it. Um, And of course, at the moment, when I look into my portfolio, I see that there are lots of stocks, and these stocks started to inch just a little bit higher, and we'll see whether this will turn out to be a fully blown bull market, or is just going to reverse for whatever reason. It's just going to come back, crash, get back into the bear market. But I think every day the chance of getting back to the bear market in the short run is getting lower. So it's very interesting days, and there has been a big discussion over the months since like October whether it's going to continue to be a huge bear market for the equities, or just the bull market is going to continue at some point. And on these moments, I recognize that even though our win percentage is somewhere at like 35 to 45%, the trend following happens to be an excellent gauge when there is a lot of uncertainty. When the news, when the people, these perma bears and everything else saying that this is going to last for a couple of years, and so on and so forth, is actually just follow the price. And the whole point is, once you're in it, if you're able to cut it short, if you can just cut loose, your entire risk on the portfolio, on your long positions, and turn them possibly to short positions, then yeah, I mean, you're just fine. I think that's an excellent way to handle the equity positions. I'm a new trend follower, so this is my second year, and I'm fascinated by the ability to have a such a diverse portfolio, and I'm looking into my portfolio. It's just stocks. Then there is this metals, then there is this energies, then there is this bonds, then there's this forex positions. It's just like, wow, what's going on here? It's just unbelievable. I'm not quite sure how you can put a portfolio like this as a buy and hold owner. It's just like not possible. But the diversity and the ability to quickly change your mind when the position goes against you, and and not miss the opportunity as an equity trader, but not become a stock trader. You are a trader, but you're not a stock trader. So you're gonna trade those stocks, but you're gonna continue to trade the forex, the credit, the commodities, all in one. And what Jerry Parker was saying is a perfect portfolio. Yeah, I mean, to be able to get closer, the more markets you add, your portfolio is going to get closer to that perfect portfolio. And I think I'm fascinated by it. And I mean, I just can't wait to see what's going to happen in the next couple of weeks. Things just getting better and better. And the year has started a little bit down for us, of course, for the trend following portfolios. It's just because one regime was ending. The regime that we have bought in last year has ended at the beginning of the year, and it's always tough for trend followers when one regime ends and another starts. So I think if this equity bull market regime is going to hold on for a couple of months, then I think our returns are, a lot of trend following portfolios are in negative territory or in a drawdown of some sort, and I think we can finish the year end in quite in a graceful period, I would say. Yeah, thanks a lot, guys. Cheers.
Hi everyone. I hope everybody's doing well. I have a question I also commented on Richard's tweet about the increased percentage of outliers with diversification. So I wrote a tweet about it, and so where I made a point. I don't know if it's a correct point or not, so I just threw it out there and I wanted to discuss. And my argument was that the number of outliers increased from, I don't know, 7% to 13% or 14% with diversification, because the point of diversification is to spread out the events across time and space. And by spreading them out, it's not that you're capturing more of them. It's not that you're capturing more outliers. So for example, if you spread them out even across the dimension of strategies, let's say you keep your universe fixed, 100 markets, but you go from, 2 systems to 4 or 6 or 10 systems. My contention is that if those systems are picked well, and of course they have to be all robust, but if their parameter sets are different enough to diversify enough from one another, to decorrelate one system from the rest, then necessarily the profits across the markets will be less clustered. So what I'm trying to say is that when you're and when let's say you're trading 100 markets and 2 systems, and you're saying only 5% of the trades are the outliers that make all the money, and those 5% were maybe distributed in, I don't know, few markets. So if the profitability of a system is dependent on too small of a cluster of trades of profitability across markets and time, then you say, oh, I'm an outlier hunter because these are the outliers that are making the profits of my system. I'm hunting them. Without them, my system would be nothing. But to the extent, let's say now, hypothetically, move this 5% number to 13 to 15%, or to 25%, or to 30%. Now, if you diversify your systems and markets in such a way in which now your system depends on types of trades which end up being 30% of all your trades, can you still call those outliers? I mean, you can say now I have a lot of outliers. I have 30% outliers. I went from 5% to 30%. But if you go to 30%, then the definition of an outlier is lost. So now you stop being an outlier hunter. You just have a nice, smooth, diversified, profitable trading system. So what do you guys think?
I agree with the principle, absolute, but I think that you'd be hard pressed to get to 30. So what I've found is that market diversification is getting me about 7%, or maybe between 5 and 10% of outliers. The system diversification, yeah, it does have its limits. I think 10 is probably the max that I'll probably be doing on it, but that does lift it to say 13%. But I think we're always going to be with this low percentage. I don't think diversification itself is going to allow us to get up to those levels of 30%. If it did, of course, we would lose the properties of outliers because 30% of our trades would be them. But in relation to the distribution of returns and how my trade distribution plots, there's clearly a bulk of trades which is about 80 to 90% of the trades which sort of fit around the mean, and then the tails, at the moment I'm taking 3R as the boundary of which I'm classifying an outlier. Everyone's going to be classifying them differently. Some people might say 5R or 10R or whatever, but I'm using 3R just as a basis to be able to compare my systems. But with 3R I'm getting up to 13%. But yeah, I see where you're coming from.
Yeah, so I agree. So we agree with everything that we're talking about here. So my point is, and my comment is that so in order for you to stay married to the concept of an outlier hunter, you are kind of forcing yourself to cluster your profitability to under 15% of the trades that are important to you. So my point is, what is your religion? Is your religion hunting outliers, which limits you to sticking to 15% of all your trades being profitable and below? Or is your religion building a robust, diversified system that spreads out profitability more across times, markets, and systems?
My religion's targeting the tail, so targeting non-linearity. So when I'm thinking of it, I'm thinking of linear results versus non-linear results.
So we have different religions. So for me, I wouldn't mind building and spreading out diverse. And what I'm saying is the difference, you would be surprised how a difference is so small, going from what you're doing now, what you call outlier hunting, to crossing that boundary of 15% and above and moving into this other space where you're actually now enjoying bigger and more benefits of diversification. Now, some people are saying, oh, but you're doing it because it's other people's money and people want smoother equity curves and better sharps. But we all inherently are doing diversification for that reason. We are diversifying for spreading out the profitability across timeframes and across markets and across systems instead of it being clustered. So when you sufficiently diversify, and we all agree that more diversification across markets and more diversification across timeframes and across systems, it's always better.
Yeah, and but there's two things here. Just quickly, there's two things here. One is a lot of people are diversifying to achieve non-correlated return streams. I'm less concerned with that because the reason I'm predominantly diversifying is to catch these anomalies as opposed to being concerned about the correlations in the return stream. So what I'm doing is I'm using system diversification as a way to assist me in breaking down the correlation for an individual market that allows me to therefore apply my method across more markets with less correlation. But the reason I'm doing that is to target what I believe are these nonlinear anomalies in the market data.
So, anyways, I saw that tweet, and I was like, well, I can't like it because I don't want to agree with that, but I do want to talk about it. So, Elon needs another category where you're like, I don't really agree with this, but you can go to your app or the desktop and you can go down that, you can find that category of things that you didn't like, but you kind of just want to come back to and to sort and organize things. So,
Jerry, you can bookmark it.
oh right, yeah. I see where people bookmark my stuff. I need to figure that out. Thank you. So, anyways, what I wanted to say was everything you're saying is correct, and I like it. But it's just correct enough, but not really correct from our point of view. Because look, we all want this and that. You're correct, but we we want, number one, of course, we're obsessed with one entry, one exit, stop loss, and sample size. We cannot get away from this, and so when we make that a condition, our religion is systematic trading, and I've said this before. My religion is systematic and backtesting, and it just so happens when I do that and I input my requirements, which is sample size, I'm a tail hunter because that's what the computer says. This is given your requirements of making money and preserving capital in your kind of crazy way of looking at it, and one entry, one exit, and a stop loss. This is what you can have. Find those outliers. And so we talk about being trend followers as if that's our religion. But I've said many times, no, honestly, we're systematic. And if we put in our same requirements, mathematical requirements, psychological requirements, fear requirements, whatever, and the computer says start taking small profits, then I think we could do it, right? So this is what I lost my train of thought too, but this is what I see as as why we can't do what you want us to, is because it violates some of our dearest held beliefs.
You're such a unique specimen of the trading universe, which and I'll tell you why. Because we have come into trading, and my background. I mean, I came to America late in my life. I didn't even know what markets are. I didn't know that markets existed. When I found out that there are markets, there where actually prices are decided by like how much somebody wants to get rid of something and somebody how much the other one wants it, and then boom, there's a price. I mean, that was like such an epiphany to me when. So I basically started from scratch, from zero. I didn't even go to school for markets. I didn't even have mentors. I knew nothing. So I was a complete tabula rasa in terms of markets, starting from scratch. And I went from first principles, from reading, from testing and my own systems and stuff like that. And I've arrived to a similar spot to where you are, considering how wide the universe is of systems and ways of making money and how ways to skin this cat. And what I find fascinating about you is that you, through the turtles and whatever, you lucked out to come to the Holy Grail immediately. And since you hit the Holy Grail immediately, you have such a conviction and you have very small reason to explore anything else. Whereas me, like guys who were tabula rasa before, who nobody showed them the Holy Grail, we have done so much research and so much traveling around and exploring, and I'm coming to a very similar conclusions. But because I've traveled so many different other places and I've come from so many other places, I'm still open to few other things for which you're reluctant to open up. And I agree why you shouldn't open up, because you already were given the Holy Grail. So why spoil it? Why waste it? Whereas if for somebody who has explored thousands and thousands of other ways and parameters and timeframes and ways of skinning this cat, I have no religion. I have religion. I'm gaining it. I'm coming close to it. I'm approaching maybe to yours. And maybe in 20 years, I will come to where you are. But it's like, which is full circle. But I probably, and people like me, probably still have to do the journey on our own. So I hope you understand where we're coming from.
Oh, that was beautiful. Yeah, no, that's a really good insight. There was another tweet that I posted a few weeks ago where it was something like, oh, it was from my friend in Asia. He sent this to me, and I told him to post this, and it was like, I came in with nothing on my agenda when I learned about trend following, and then other people who come into trading or systematic or trend following with baggage, in life and way too much smarts and degrees and knowledge, it's harder for them. They have to get rid of a lot of stuff. Now you're accurately going to and saying, well, post that now. You got the Holy Grail from the people who hand out those things, and they certainly were brilliant. And now you can't expect all of us who weren't there to come to these same conclusions so quickly. That's very insightful, and it's probably true. I mean, I got to think about that. That's a lot here with 15 minutes to go. I've got to think about that for a couple of days and see what my conclusion is. But yeah, but I will say that their bottom line was systematic too, and it absolutely was not trend following, since none of them trend follow any longer. Hardly any of the turtles do much trend following. So, but we were always taught to do research and be open minded. So I feel like that we've done that to some degree, but when I hear a lot of stuff going on podcasts and writing and stuff from people who were there with me, it's a tremendous violation of some of the things we've taught. So, which is fine. So I definitely researched things, and I believed what we were taught was true. And I believe it more than the people who taught us probably by now, that it's still true. And we were taught that it's going to always be true, these basic large principles. So I'm guilty, of taking them seriously. And sometimes that's what, not to get too crazy, but the turtles was not the first nickname. The first nickname, we were like, someone said, you guys need a nickname, or the people taking out orders need a nickname for us. And people were like the disciples, the apostles. And so I think that's how my personality is. If I get a hold of something and someone who I think is just a genius, I really want to become more of a disciple, and a worthy disciple, and a worthy, loyal believer. And I think that's my personality. And so obviously I say that I have done research, and I was willing to be open-minded and try other things and tinker a bit, certainly no doubt tinker with trend following most of the times to my chagrin. But, obviously I didn't have that kind of open mind, thankfully, in my opinion, that some of the other guys had and girls had. But that's a very good insight.
Hello, Jerry.
Good morning, Michael.
Yeah, I want to say to Absolute, first of all, hi everyone, have a nice weekend. I want to say to Absolute that the Holy Grail was discipline and nothing more. The systems were trivial, and they are still trivial. And the discipline is the Holy Grail. Now, going to diversification, when you add markets, you get fatter tails in the distribution. You need to add systems to get those tails thinner, because that increases the statistical significance of the system because it makes the possibility that the expectation is robust. So this is the statistical explanation. Now, earlier on, I heard that you are risking 15 basis points. So I figure out at the limit of full, when you are fully invested, you can do 666 markets. And this was quite interesting to me.
Well, I'm not going to be offended at all by your comment that it's all about discipline and the systems were, I forgot the words you used, but simple, trivial. Well, I wouldn't say that I disagree with that totally. I mean, I think that they're very amazingly great. And obviously, they're better than everyone else's because they don't go too far. And that's, in some respects, really one of the keys. And they're amazing at making money, and they're amazing at preserving capital and balancing that out and true risk control. And that's not based on vol, but based upon much deeper things that people should be concerned about. But I do think, and you can never go wrong, since we can all walk and chew gum at the same time. We can bite off projects, and a project that I highly recommend for everyone is make your system better and make it tie in with a beautiful, wonderful philosophy of how it all should work. And get rid of things, which I have done, thanks to Richard and thanks to others on this spaces. You know, who was the other guy? I can't think of his name, but he used to work at TransTrend, I think. Yeah, he lectured me one day about including short-term interest rates. I'd taken short-term interest rates off my list of markets, and as soon as I got off that spaces, I added them back because he told me philosophically why that you should have them on there, and I was like, yeah, you're right. I cannot argue with that. It's way more powerful than him showing me some stupid back test, but he was correct. So that's what I've always done is try to understand philosophically what do I want to do, what's safe, what's unsafe, and then the benefits and the specific systems will flow from that. And Richard, he got me focused back again on the bottom line of hunting outliers. So I feel like that it is very important to make those systems as good as they possibly can be. Uncover any things that have slipped in that you need to get out or put back in. And this is very important. Even though if they're trivial, even though they don't have a lot of moving parts, one entry, one exit, a stop loss. Trade level. I've made major inroads with trade level. I talked to other turtles about my inroads and how I made it a little bit better, the trade level calculation, cutback calculations, and they're like, yeah, that's brilliant. Okay. However, I agree totally that, and I've said this many times, the benefit of systems is consistency. That's all it is. It's making sure whatever system you have, a good one or a bad one, an average one or a really good one. And I remember Rich saying many times, an average system, if that's all you can do, is something that's pretty darn average. And don't confuse that with your personality wants you to trade shorter term and you know you shouldn't. That type of average system consistently applied is going to do better than a better system that is not consistently applied. So that's the reason that the systems exist, is just so we handle every situation in the markets the same way each time.
Well, Jerry, the turtle system became known pretty soon after it was disclosed to you, and it underwent many changes. And these were in the public domain, but very few people survived. You are, of course, the survivor and a winner and an example. So it doesn't seem to me there was something unique about the turtle system per se, meaning the mechanics. It was the devotion and the discipline and the and all the other psychological aspects to follow those systems and execute them, because I also traded them. And for some time I couldn't do it. I had to watch the markets during when I was sleeping, and it was making me upset that something could go wrong. So it was more like psychology and discipline, and nothing to do with the simple systems that you can program with 10 lines of code.
Yeah, at some point though, those systems were not good anymore, and you needed to trade longer term, and they were too volatile, and drawdowns were too big. But I think the core philosophy of classic trend following is, regardless of how you, even if you have an optimal parameters, it is very difficult to do.
Jerry, most one of the salient points, in addition to what you've said, for me about trend following is that it is the singular approach about reactive versus predictive. Everything else I've seen in trading is about predicting and speculating and guessing, and with really terrible results. And yet, TF is the only place I can find reactive, and it makes so much sense to me ever since I learned about it maybe a year and a half ago, 2 years. Thanks.
Well, people get upset that when we say that because I guess to some degree we are predicting trends, and we're predicting that we're going to do well. So I think it's better just to say that in the sort of usual way that people trade, we don't do too much predicting. We're not completely systematic because we use discretion to choose the systems, and so I've gotten away from that as well. So all we do is we attempt to follow rules that maybe some of them, some or too much discretion has been used to create those rules. But and then hopefully we're certainly not predicting in a sense. When people ask me, like I have friends who ask me about gold, like gold, and I'm like, well, I don't really. I'm wrong 60% of the time. I don't really look at it as having some insight on gold right now. I know from a trend following point of view, the right position is long, but that basically means I need to, in order for that to sort of have any validity at all in my life, I have to do that same trade and be long in this, in this instance when these breakout rules are elected every single time for the rest of my life. And they're like, wow, it doesn't sound like you're that smart. I'm like, yeah, no, it's not really me analyzing like a fundamental discretionary person and really having an edge on this here right now trade. We have an edge on the next 20 or 30 or 40 years if we follow the systems in a consistent way.
Yeah. I've said this I think before, but I think I can state it a little bit better this time in terms of us predicting or not. I'm on the side that we are predicting, but what we're doing is basically saying things that are up are more likely to be up than down across all time frames, across all markets, across anything that's moving in the world. Anything that's up, we're betting it's more likely to go up, and anything that's down, we're betting it's more likely to go down. Now, this edge, this probability of things that are up, the likelihood of a thing that's up for it to be up going forward may be 51 to 49%, or even 50.5 to 49.5, or 50.1 to 49.9%. However, we have a statistical edge. We're a casino. We're betting that everything in the world, you look at the world, you scan the world across all markets and across all time frames, and ask yourselves, what is up? Is this thing up? It's up. I'm betting it's going to go up. Is this thing down? It's down. I'm betting it's going to go down. Wait a minute. Up on what time frame? 20 days, 20 days. Is it up on 20 days? It's up on 20 days. Yeah, I'm up. I want to belong it. Is it down on 20 days? I want to be short. Oh, 20 months. Is it up in 20 months? I want to be long. If it's down in 20 months, I want to be short. We are a casino. We're making hundreds and thousands of bets against the rest of the world, in which we're offering liquidity, and we're a casino. The other players who are taking the other sides of the bet, they don't know this edge, and they're playing against us. We're the casino, and we're predicting that everything that's up, it's more likely to be up going forward, and everything that's down, it's more likely to be down going forward, albeit with infinitesimal statistical odds. But those infinitesimal statistical odds, 51 to 49 or whatever, they're indistinguishable from a coin flip. But when applied consistently over 100 markets, timeframes, and systems, when you apply them consistently in thousands and thousands of bets, that edge accumulates, and that's how we make money.
However, I cannot agree with that because probability speaking, we don't have an edge because we're wrong 60% of the time. It is just when we're right that 40%. I mean, 40% could be a little high as well, but it's only by those outliers or those winning 40% being much larger than the losing 60%. So it's more complicated than the probabilities. And wouldn't you say?
That's, Jerry, that is because of the design of your system. But your system has those statistics because of these more fundamental statistical bias that I just described. This more fundamental statistical bias, which is things that are up are more likely to be up and things that are down are more likely to be up. This is the basis. This is the fundamental of the fat tails. This is the fundamental of the positive correlation in the markets, where future is slightly positively correlated with the past. Slightly, not a lot. The future is slightly positively correlated with the past. There's autocorrelation. And it's because this autocorrelation exists. That's why the markets are not normal noise, Gaussian noise. And that's why the tails are fatter than normal Gaussian distribution is. And that's why you and Rich can hunt the outliers. But the fundamental force that's driving is what I just said. It's the positive correlation between future return and the past return.
Well, this is correct, but this is what has changed since the 80s and 90s, when there was autocorrelation at the one lag, and now you have a autocorrelation at higher lags, and there is no barrier to entry. Everyone can do it. So you have to increase the breakout periods, and due to that, you have larger drawdowns. It's not an easy game. Autocorrelation means very little if you cannot have the right risk management and the diversification, as Rich and Jerry say, and the proper system. So autocorrelation is necessary at some lag, but not sufficient.
Absolutely, I agree with that. And nobody said that the autocorrelation is consistent and constant and all time lags. Just like the casino doesn't make money every day on all of its machines. And like the casino sometimes is losing its jack black or loses on one machine, wins on another. So what I'm saying is this phenomenon has to be persistent in there, but it's chaotically shifting in the time frame and the market's two-dimensional universe. So this is the devil is here. The devil is in the chaotic movement of how this effect moves around the markets, but it's there at all times. So what you just noticed that at some auto leg there used to be an autocorrelation in the 80s, now there is not. Yes, there was, and now it's not. Now it's somewhere else. But can you build a casino with a sufficient amount of machines and tables and whatever, that however the devil of chaos moves around, you end up running a profitable casino regardless of where this phenomenon is being reflected?
Yeah, at some point there are diminishing returns from this, depending on the number of participants in the markets because it's a zero-sum game. So again, this is more like a philosophy and of the autocorrelation in the markets. Non-stationarity is your friend to make money, but also your enemy. You can lose money, okay, etc., etc. You always have new players joining in because of the spaces and the information becomes available. So making money becomes harder just because of the things you talked about, which I agree with.
Okay, thanks for being here, everyone. Have a good weekend. Richard, thanks for being here. Thanks for all your recordings and all your input.
Thanks, Jerry.
See you guys next week, next Friday.